Welcome back. A firmer tone for stocks this morning. Futures indicating a rally at the start of trading this morning as we look ahead to the November Consumer Price Index. It's out at 8:30 a.m. Eastern. We're expecting a gain month over month and year over year, up 0.3% for the month, 7.3% year over year for the CPI. Joining me right now to look ahead to the economy and markets is CFRA Chief Investment Strategist Sam Stovall. Sam, it's great to see you this morning. Thanks so much for being here. Are these estimates in line with your expectations? And what do you think how do you think markets will react?
Good morning, Maria. Well, yeah, I think these are definitely in line with our expectations. And I think we got a preview as to how the market will react based on last week's PPI numbers. We missed the monthly number by 0.1% of 1%, and the market pretty much tanked, even though the year-on-year percent change continued its decline. So this time around, I think it will be important that we end up seeing a decline in the year-on-year number as well, looking right now for 7.3% on the headline, 6.1% on the core. And if we get these kind of numbers, I think investors will breathe a sigh of relief. If it's even lower than that, then I think we could see a nice upward move in the market.
Well, maybe, but what does this mean for the macro story, Sam? I mean, the Federal Reserve has been raising rates, consistently. The Fed is kicking off another meeting today, the final meeting of the year, today and tomorrow, and we're expecting another rate hike to be announced on Wednesday, 0.5 percentage point, 50 basis points versus the 75 basis points we've seen for the last 4 meetings. And yet I'm looking at a report this morning from J.P. Morgan's Marco Kalanovic. He's reiterating a note to clients that he sees downside risk for the stock market between now and the end of the first quarter. They are cutting their equity allocation due to a soft economic outlook in 2023, rating stocks moderately underweight. This is J.P. Morgan's strategist. Your thoughts on what the stock market is going to do as the economy weakens as a result of these rate hikes?
Well, I think that's a good way of describing what I believe is going to happen next year. I call it a tale of two halves, that in the first half, I think investors will continue to be quite cautious because we have not really fallen into the recession that so many people are anticipating. Historically, whenever we've had inflation above 6%, we've had a bear market with a recession. Whenever the leading economic indicators have been negative year on year, we have fallen into recession. And also Q4 22, Q2 23 earnings are expected to be negative, with the intervening quarter Q1 being up only 0.5%. So we are getting pretty close to an earnings recession. So I think that investors are going to continue to add volatility to the market and worry about what happens. But by the second quarter of next year, investors will be looking across the valley into an end of the year in which the Fed will at least be thinking about, if not acting upon, lowering interest rates.
Okay, so you're expecting a tougher first half than the second half. First half of the year, you think could be choppy in terms of the economy and the stock market. Why would I want to buy stocks here then? Should I be selling into this rally?
I think it all depends upon how good your timing technique is. I explained that back in 2009, if you had purchased on January 6th, which was a 25% advance off of the November 20th of 08 low, we only fell into another 27% decline through March 9th. Yet by holding on, even if you bought at that top in early January, you were back to break even by June 1st, and you were up 20% for the full year. So unless you have an uncanny ability to time the market exactly, I think you're better off nibbling and adding to positions rather than trying to lighten up.
Yeah, keep the focus long term. Liz Peek, jump in.
Good morning, Sam. Question for you. So much hinges on the consumer, and we get such mixed signals. Consumer credit debt is up 15% year over year, and yet spending continues strong. What's your view? Is the consumer running out of gas?
I think the consumer is cautious because certainly they are listening to the financial media. They're concerned about conversations about inflation. They see it obviously every day. And so I think they're being cautious about their purchases. Also, those people who are looking to buy homes are now experiencing mortgage rates above 7%. So, the concern is that they want to keep their powder dry. Yet if we continue to see the unemployment rate at 3.7%, we don't really seeing it even touch 4% until the end of 2023. I think the consumers still will have enough money in which to satisfy their consumer needs as the year progresses.
All right, we will leave it there. Sam, it's always a pleasure. Good to see you, sir. Thanks very much.